Over the past few hours, several global bank stress indicators moved sharply higher. Funding spreads widened. Short-term borrowing costs jumped. In the United States, a regional bank that had already been under quiet pressure failed to secure emergency capital and was forced into resolution. At the same time, gold surged and silver followed with unusual speed. Individually, none of these events would be shocking. Banks fail from time to time. Metals often rise during uncertainty. Markets adjust. But taken together, and happening almost simultaneously, the pattern feels different. It does not follow the typical script. In a normal environment, stress builds gradually. Analysts debate. Central banks prepare statements. Liquidity facilities are activated before panic spreads. Bond yields fall in a measured way as investors seek safety. Equity markets wobble, but remain orderly. Gold moves higher, but not violently. What we are seeing instead is a sudden tightening of financial conditions, while official messaging remains relatively calm. Funding markets are signaling strain before policymakers fully acknowledge it. That divergence is important. Banks are not simply vaults of cash. They are leveraged institutions built on confidence. They borrow short and lend long. They rely on stable deposits, predictable collateral values, and functioning wholesale funding markets. When short-term funding costs rise quickly, even well-capitalized banks can feel pressure. Not because they are insolvent, but because liquidity becomes more expensive and less certain. The failed regional bank was not the largest institution in the system. It was not globally systemic, but it operated in sectors already under strain: commercial real estate, small business lending, and regional development. These are areas sensitive to higher interest rates and slower growth. When asset values soften and refinancing becomes costly, balance sheets tighten. At the same moment, gold markets reacted as if something deeper was shifting. Gold does not move sharply because of one small bank. It moves when trust in the financial structure appears to weaken. Silver, which sits between industrial demand and monetary speculation, amplified the move. That combination suggests capital was not just hedging volatility. It was repositioning. This is where pattern recognition matters. Over the past 2 decades, major financial disruptions shared a common early signal. Stress appeared first in plumbing markets, repo rates, interbank lending spreads, credit default swaps, before the broader public understood the implications. By the time headlines turned urgent, institutional capital had already moved. Today's spike in stress indicators may not mean a systemic collapse, but it does indicate that the cost of money is rising in ways that strain weaker balance sheets. And in a highly interconnected global system, weakness rarely stays isolated. We must also consider the broader backdrop. Interest rates remain elevated compared to the past decade. Governments carry record debt loads. Commercial property markets face refinancing walls. Geopolitical tensions are reshaping trade routes and supply chains. In such an environment, even a modest liquidity shock can reveal hidden fragility. The key tension is this: banks are supposed to provide stability during uncertainty. They are the transmission mechanism for monetary policy and the backbone of credit creation. If stress inside banks begins to rise while economic growth is already slowing, policymakers face difficult trade-offs: lower rates too quickly and inflation risks returning. Keep rates high and more institutions may feel pressure. Markets are now asking a quiet question. Is this an isolated case of poor risk management at one regional bank? Or is it the first visible crack in a system adjusting to a higher cost of capital? The behavior of metals suggests that at least some investors believe this event carries broader meaning. Gold does not analyze press releases. It responds to shifts in confidence. When trust weakens at the margin, gold often reacts before equities fully price the risk. This is why the headline matters less than the signal beneath it. The story is not simply that a bank failed. The story is that stress indicators, funding markets, and safe haven assets move together quickly. If this is contained, liquidity will normalize, spreads will tighten, and metals will cool. But if it is not, then what we are witnessing may be the early stage of a broader repricing of risk across credit markets. To understand which path we are on, we need to look beyond the surface and examine what has changed in the rules themselves. and why markets may be signaling that the old playbook no longer applies. To understand whether this moment is contained or structural, we need to revisit the usual playbook. Financial stress follows patterns. When banks wobble, central banks typically respond quickly. Liquidity facilities expand. Emergency lending windows open. Bond yields fall as investors rush into government debt. Equity markets pull back but stabilize once policy support becomes clear. Gold rises, but often in a controlled and steady way, reflecting caution rather than alarm. That is the standard sequence. Under normal stress conditions, falling bond yields act like a pressure valve. Lower yields ease funding costs, support bank balance sheets, and signal that monetary authorities are leaning toward accommodation. Credit spreads widen, but gradually, markets digest the shock. But today, parts of that script appear distorted. Bond yields have not fallen decisively enough to offset the jump in short-term funding stress. In some maturities, yields remain elevated, suggesting that inflation expectations or sovereign debt supply are limiting the safe haven bid. Liquidity injections, where they exist, appear targeted and measured rather than broad and overwhelming. Policymakers are cautious. They are aware that aggressive easing could reignite inflation pressures. Meanwhile, gold and silver reacted quickly, faster than credit spreads alone would justify. That divergence matters. If metals are moving ahead of bond markets, it may signal that the concern is not just about one bank's solvency. It may be about confidence in the financial architecture itself. History offers useful parallels. In the months before the 2008 financial crisis intensified, stress first appeared in interbank lending markets. Funding spreads widened quietly before equity markets fully grasped the scale of the problem. In 2019, repo markets experienced sudden tension, forcing emergency Federal Reserve intervention, even though broader markets seemed calm. In 2023, regional bank failures revealed how quickly deposit flight could accelerate in a digital age. In each case, the early signal was subtle but clear. Parts of the system stopped behaving normally. The lesson is not that every stress spike becomes a crisis. Most do not. The lesson is that rule-breaking behavior deserves attention. When safe assets fail to rally decisively during bank stress, it suggests competing pressures. When liquidity support is cautious rather than overwhelming, it suggests policy constraints. When gold moves aggressively before equities reprice, it suggests a deeper layer of concern. Gold historically responds to declining trust in intermediaries. It reflects skepticism toward balance sheets, counterparties, and policy responses. Silver, by contrast, often magnifies volatility. It sits between monetary demand and industrial demand, making it sensitive to both fear and growth expectations. When both metals move sharply during a bank event, the message is layered. This does not automatically imply systemic collapse, but it does imply that investors are hedging against more than a single headline. They may be positioning for broader credit tightening, prolonged higher funding costs, or policy miscalculation. Another subtle signal is the relationship between equity markets and credit markets. If equities remain relatively stable while funding spreads widen, it can mean that equity investors expect policy support, while credit investors are less convinced. Credit markets tend to be closer to balance sheet reality. They price default risk directly. When credit signals diverge from equity optimism, the tension is worth monitoring. What appears to be breaking down is the clean transmission between stress and relief. In past cycles, liquidity quickly suppressed volatility. Now, liquidity is constrained by inflation concerns and sovereign debt burdens. Central banks may want to ease aggressively, but they cannot do so without risking credibility. That constraint changes the game. If the traditional pressure valve is partially blocked, stress may linger longer inside bank balance sheets. Commercial real estate exposures, leveraged corporate loans, and long-duration bond holdings become more sensitive to elevated rates. Small shifts in asset values can have outsized effects when leverage is high. This is the big signal. The market's reaction suggests that the issue may not be isolated mismanagement. It may reflect accumulated pressure from a prolonged period of tight monetary conditions colliding with highly leveraged balance sheets. If that is true, The important question is no longer whether one bank failed. The real question becomes structural. If the system is showing strain, where is the pressure really coming from? If the system is showing strain, where is the pressure really coming from? To answer that, we have to step away from the headlines and look at the structure beneath them. Banks do not exist in isolation. Their balance sheets are deeply connected to commercial real estate, sovereign debt, corporate credit, and the arteries of global trade. When stress appears in one area, it often reflects tension building somewhere else. Start with commercial real estate. Over the past decade, low interest rates encouraged aggressive borrowing. Office towers, apartment complexes, logistics centers, and retail developments were financed under the assumption that capital would remain cheap and demand would remain stable. But rates rose quickly. Property valuations adjusted slowly. Now, many loans are approaching refinancing dates, what analysts call a refinancing wall. If buildings are worth less and funding costs are higher, new loans may not cover old debt. Losses emerge not suddenly, but through rolling maturities. Banks, especially regional ones, hold large exposures to these loans. Even modest valuation declines can strain capital ratios when leverage is high. That is one hidden pressure point. Next, consider sovereign debt. Governments across developed markets carry historically high debt burdens. As rates increased, the cost of servicing that debt rose. Banks hold large amounts of government bonds as safe assets. When bond prices fall due to rising yields, unrealized losses build. If deposits remain stable, those losses can sit quietly on balance sheets. But if depositors withdraw funds, banks may be forced to realize them. What was once an accounting detail becomes a capital event. Corporate credit adds another layer. Many companies borrowed heavily during the low-rate era, issuing long-dated bonds and securing floating-rate loans. As rates rose, interest expenses climbed, margins tightened, default risk increased at the edges. Banks and credit funds that financed this expansion now face a slower growth environment and higher credit risk. These pressures do not operate independently. They reinforce one another. Now widen the lens further to global supply chains. Trade flows determine revenue streams for companies, tax income for governments, and collateral values for lenders. When supply chains function smoothly, goods move efficiently, inventories remain balanced, and profits stabilize. But when geopolitical tensions rise or trade slows, earnings weaken. Weaker earnings reduce asset values. Lower asset values reduce collateral quality. Banks respond by tightening credit. The cycle feeds itself. Recent years have already tested supply chains through pandemic disruptions and geopolitical realignments. Companies are reshoring production, diversifying suppliers, and holding more inventory. These shifts require capital. They also reduce short-term efficiency. Slower trade growth affects shipping volumes, manufacturing output, and export revenues. For banks exposed to trade, finance, or industrial lending, that slowdown translates into thinner buffers. Geopolitics intensifies this dynamic. Nations are no longer optimizing purely for efficiency. They are optimizing for resilience and strategic control. Critical minerals, energy infrastructure, semiconductor production, and agricultural supply chains are being secured domestically or within trusted blocks. Capital flows follow these priorities. When countries accumulate strategic materials, they often increase gold reserves as well. Gold becomes more than a financial hedge. It becomes a neutral reserve asset outside the direct control of another nation's currency system. Over the past decade, several central banks have steadily increased gold holdings. That accumulation sends a signal about long-term trust in the existing monetary order. At the same time, some nations are exploring trade settlement outside the traditional dollar framework. Not a sudden abandonment, but incremental diversification. Energy contracts priced in alternative currencies. Bilateral trade agreements bypassing established channels. Each step is small, but the direction matters. For banks operating inside the dollar-based system, shifts in capital flows can change liquidity dynamics. If foreign demand for dollar assets softens at the margin, funding conditions tighten. If geopolitical fragmentation increases, cross-border lending becomes more complex and risk premiums rise. This is the real battle, leverage and control. Who controls energy routes? Who controls critical minerals? Who controls reserve assets? Financial markets reflect these questions before politicians state them openly. The spike in bank stress, then, may not simply be about poor risk management at a regional institution. It may be the visible edge of deeper structural adjustments. Higher rates are testing leverage built during years of easy money. Supply chains are being redrawn along political lines. Capital is repositioning around strategic security rather than maximum efficiency. When leverage, geopolitics, and funding costs converge, pressure builds inside balance sheets. And sustained pressure inside balance sheets eventually forces a monetary response, which leads to the next layer of the story. How this structural stress feeds directly into currency, stability, inflation expectations, and the long-term credibility of money itself. When leverage, geopolitics, and funding costs converge, pressure does not stay confined to bank balance sheets. It flows outward into the currency system itself. Because at the center of every banking structure sits a promise that deposits are stable, that money holds value, and that central banks can manage both growth and inflation without breaking trust. This is where the dilemma becomes clear. When banks struggle, central banks face two competing priorities. On one side is financial stability. If funding markets freeze or institutions fail, policymakers are expected to inject liquidity, lower rates, and calm the system. On the other side is currency credibility. If inflation remains elevated or public debt levels are high, aggressive easing can weaken confidence in the currency's long-term value. Lower rates too quickly, and inflation expectations may rise again. Hold rates high for too long, and more institutions may face solvency stress. There is no perfect balance. In recent cycles, central banks often chose financial stability first. During the global financial crisis, rates were cut rapidly. Quantitative easing expanded balance sheets. Liquidity overwhelmed stress. Inflation remained subdued, giving policymakers room to act. The currency system absorbed the shock. Today, the environment is more constrained. Inflation has already tested credibility in many developed economies. Government debt levels are significantly higher than they were in prior cycles. Bond markets are sensitive to supply. That means policy flexibility is narrower. This tension is precisely why gold reacts when confidence in monetary policy begins to weaken. Gold is not just a commodity driven by jewelry demand or industrial use. It is a monetary asset without counterparty risk. It does not depend on a government's fiscal discipline or a central bank's credibility. When trust in policy becomes uncertain, gold often reflects that uncertainty. Historically, gold has performed strongly during periods when real interest rates fall, or when investors expect central banks to tolerate higher inflation in order to stabilize growth. It tends to move ahead of formal announcements. Markets price expectations before policy shifts are confirmed. Silver behaves differently, but amplifies the signal. Because silver has both industrial and monetary characteristics, it becomes more volatile during transition periods. If investors expect monetary easing alongside continued industrial demand, silver can accelerate. If growth fears dominate, it can pull back sharply. Its movement often reflects the tug-of-war between inflation risk and economic slowdown. The hidden consequence of banking stress is not simply isolated bank failures. It is capital rotation. Money does not vanish when confidence shifts. It relocates. Depositors who feel uneasy may move funds into treasury bills, money market funds, or larger institutions perceived as safer. Institutional investors may increase allocations to short-duration sovereign debt. Others may purchase physical gold or diversify into foreign currencies. If this rotation remains contained within one country, the currency system can adapt. But if multiple regions experience stress simultaneously, global capital flows become more complex. Investors compare relative stability. They assess fiscal discipline, political cohesion, and inflation control across major economies. The US dollar remains the dominant reserve currency. It benefits from deep capital markets, legal infrastructure, and liquidity. That dominance does not disappear overnight. However, dominance can be slowly repriced at the margins. If foreign central banks diversify reserves incrementally, if trade settlement shifts gradually, if trust erodes slightly, the cumulative effect can alter capital flows over time. This is not about collapse. It is about calibration. Banking stress raises questions about the credibility of fiat systems because fiat money relies entirely on trust. There is no physical backing. Its value depends on disciplined policy, stable institutions, and economic productivity. When those elements appear strained, even temporarily, investors seek assets outside the credit-based system. Gold becomes a mirror. Bond yields become a referendum on fiscal sustainability. Currency exchange rates become signals of relative trust. The deeper macro story is therefore not just about whether banks are solvent. It is about whether the system that supports them can maintain confidence under pressure. If policymakers are forced to choose between stabilizing banks and defending purchasing power, markets will watch carefully which side receives priority. And that brings the story closer to home. Because while these dynamics unfold at the macro level, their consequences filter down to pensions, savings accounts, mortgages, and employment stability. The next question is unavoidable. In a system defined by leverage and shifting trust, how exposed is the individual inside it? The next question is unavoidable. In a system defined by leverage and shifting trust, how exposed is the individual inside it? To answer that, we need to move from macro headlines to practical mechanics, not to create fear, and not to offer prescriptions, but to build clarity. Because when systems feel unstable, the most useful tool is understanding. Start with what we can call the confidence model. Banks do not operate like safes filled with idle cash. They operate on fractional reserves and continuous flows. Deposits come in and are lent out. Short-term funding supports long-term assets. As long as depositors trust the institution and counterparties trust one another, the system functions smoothly. Liquidity is available because everyone assumes it will be available. But confidence is not linear. It holds steady for long periods and then shifts quickly. When trust weakens, even slightly, depositors move funds, lenders demand higher rates, and liquidity can evaporate faster than balance sheets adjust. The institution may still have solid long-term assets, but short-term funding pressure can create instability. For individuals, this model matters because confidence influences everything from mortgage availability to small business loans. If banks tighten standards to preserve liquidity, credit becomes harder to access. Economic activity slows at the margins. That affects employment stability and wage growth, even for those far removed from financial markets. Next is the leverage model. Leverage magnifies both gains and losses. In simple terms, if an institution owns $100 in assets funded by $90 in debt and $10 in equity, a 10% decline in asset value can erase the entire equity cushion. The assets may still exist, the loans may still perform, but accounting losses reduce capital buffers. Modern financial systems are layered with leverage. Banks, corporations, private equity funds, real estate vehicles, and even governments. When rates rise or asset prices soften, small percentage changes can have outsized effects. Losses do not need to be catastrophic to matter. They only need to exceed thin equity margins. For households, leverage appears in mortgages, auto loans, and credit lines. For retirement savers, it exists indirectly through pension funds and investment vehicles that use borrowed capital to enhance returns. When leveraged structures unwind, asset prices can adjust quickly. Property values may stall. Equity markets may repress. Pension funding ratios may fluctuate. The third framework is the rotation model. Capital rarely waits for confirmation. It moves in anticipation. Institutional investors shift allocations based on forward expectations, not past headlines. Deposits migrate from smaller banks to larger ones. Money flows from risk assets to short-term government bonds. Allocations tilt toward commodities or foreign currencies when policy credibility is questioned. By the time media coverage intensifies, much of the rotation has already occurred. For individuals, this explains why markets sometimes feel disconnected from news cycles. A pension fund may adjust exposure months before a recession is officially declared. A currency may weaken gradually, long before policymakers acknowledge structural stress. Understanding rotation reduces confusion. It highlights that price changes often signal expectation shifts, not current conditions. Taken together, these models reveal something important. Most people are indirectly embedded in the financial system through retirement accounts, home equity, employment income, and savings vehicles. Households are linked to bank balance sheets and capital markets. This is not a reason for alarm. It is a reason for awareness. When confidence tightens, credit slows. When leverage compresses, valuations adjust. When capital rotates, asset prices reflect shifting priorities. None of these processes guarantee crises, but they define the channels through which macro stress filters into everyday life. And now the larger question comes into focus. If these pressures continue, if confidence wavers, leverage is tested, and capital keeps rotating, what paths could the system realistically take from here? And now the larger question comes into focus. If these pressures continue, if confidence wavers, leverage is tested, and capital keeps rotating, what paths could the system realistically take from here? There are several plausible outcomes. None are guaranteed. Markets are complex systems shaped by policy decisions, investor psychology, and external shocks. They rarely move in straight lines. But framing the possibilities helps clarify what to watch. The first scenario is containment. In this path, liquidity support proves sufficient. Central banks expand targeted facilities. Stronger institutions absorb weaker ones. Deposit outflows stabilize. Bond yields ease modestly, relieving pressure on balance sheets. Gold and silver cool as immediate fears fade. Equity markets regain footing, interpreting the episode as a stress test rather than a systemic fracture. Under containment, confidence dips but does not break. Policymakers manage the trade-off between inflation control and financial stability without losing credibility. The event becomes a reminder of higher rate consequences, not the beginning of a broader unwind. The second scenario is a slow burn. Here, stress does not explode, but it lingers. Additional regional banks report funding strain. Commercial real estate losses surface gradually as refinancing walls are met. Credit standards tighten quietly across lending channels. Economic growth softens. Metals grind higher over time, reflecting persistent hedging demand rather than acute panic. Currencies fluctuate as markets reassess policy flexibility. In a slow burn environment, there is no dramatic collapse. Instead, there is ongoing repricing. Asset values adjust downward in stages. Volatility becomes more common. Confidence erodes incrementally, not suddenly. Policymakers respond in measured steps, attempting to balance inflation risks against mounting financial fragility. The third scenario is structural reset. In this case, prolonged stress forces major policy shifts. If multiple institutions face solvency pressure simultaneously, or if sovereign bond markets become unstable, central banks may be compelled to intervene more aggressively. That could include broad liquidity injections, coordinated international support, or even forms of yield curve control to cap borrowing costs. Such measures would aim to stabilize the system quickly, but they could also alter long-term expectations about inflation and currency discipline. If markets interpret emergency coordination as a sign that traditional tools have been exhausted, gold and other real assets may respond strongly. Trust in fiat systems would not disappear, but it could be recalibrated. These scenarios are not predictions, they are frameworks. Reality may combine elements of each. A contained event could transition into a slow burn. A slow burn could eventually require structural intervention. Across all paths, one variable remains central: confidence. Confidence in bank solvency, confidence in policy competence, confidence in currency purchasing power. When confidence holds, leverage can be managed. When it weakens, even small shocks can cascade. The recent spike in stress indicators may prove temporary, or it may be remembered as an early signal that pressure was building beneath the surface. Markets often provide warnings before outcomes are clear. Which brings us to the forward-looking uncertainty that matters most. If this spike is not the crisis itself, but an early warning, what happens when the next pressure point hits? What if refinancing stress in commercial real estate accelerates? What if sovereign debt markets demand higher yields at the same time banks need relief? What if geopolitical escalation disrupts trade flows again? Each of those sectors carries its own leverage, its own vulnerabilities, and its own potential to amplify financial stress. In our next analysis, we will examine the single most exposed sector right now, the area where rising rates, declining asset values, and refinancing risk converge, and why it could determine whether this episode fades quietly or evolves into something far more consequential.